Price is what you pay and value is what you get. This famous quote from Warren Buffett highlights the focus of this video. Value. In this video we're going to take a look at 3 different aristocrats that I think offer more value than their current price. Hence, they are undervalued dividend stocks. Each stock is expected to return more than 20% annually until the end of 2021. Hello ladies and gentlemen, this is Tom from the Dividend Attitude Show. In today's video I will analyze 3 dividend aristocrats that I deem to be undervalued right now. General Dynamics, Aero Financial Corporation and Eaton Vance. I'm planning to start a new series on doing a deep dive in-depth analysis of dividend aristocrats, 1 per episode. So please let me know in the comments below which dividend aristocrat you would like to see analyzed by me. But first, let's get started with today's episode. First up is General Dynamics. Now this is a company that has not really been on my radar before. I guess the ticker looks too much like GE and that scared me away. Now all jokes aside, I think it is because this is another one of those companies that is not often discussed on social media, or maybe I just had a blind eye to it. General Dynamics is a global defense contractor and one of the world's leading global aerospace and defense companies. They sell a wide range of products from submarines and combat vehicles to IT communication systems. A large part of General Dynamics' revenue comes from the US government and other military customers, about 85%, with the remaining 15% coming from the international commercial customers. This dependency on the government is both a blessing and a curse. A blessing because it is very unlikely their customers go bankrupt, and a curse because they are highly reliant on government spending. This causes cyclicality in the revenue of General Dynamics, so that is definitely something to keep in mind. General Dynamics is divided up into 4 business segments: aerospace, combat systems, information systems and technology, and marine systems. General Dynamics is part of the industrial sector. General Dynamics has been raising its dividend for 29 years in a row now, so despite being a cyclical company, they managed to raise their dividends for 29 years. The current earnings payout ratio is also stellar for an industrial company, being just under 40% at 39.3%. It has been in the mid to high 30s range for a few years now, so a very stable payout ratio. Their free cash flow payout ratio is a bit on the high side with 64.6% though. The dividend payout graph shows a nice stable uptrend. What I like about the dividend growth of General Dynamics is that the dividend growth rate of the 1, 3, 5 and 10 year dividend growth are all within a 1.5 to 2% range of each other, with the 1 year growth rate at 8.7% and the 10 year growth rate at 10.4%. Despite its cyclicality, General Dynamics has an excellent dividend safety score of 97. That also has to do with their very high barrier to entry mode. The products that General Dynamics provides are very complex and often take decades to develop. The process to obtain defense contracts also takes a very long time. In the defense sector there are duopolies for each specific type of equipment, where General Dynamics and Huntington are usually awarded with the Navy shipbuilding contracts. The revenue growth of General Dynamics is not as fast as I would like to see, with a 32.5 billion revenue in 2010 and a 38.8 billion in 2019, for a growth rate of 2.33%. Their revenue did grow fast in recent years though, as you can also see in the revenue graph. So that is not supporting the 10% dividend growth rate, but interestingly, the payout ratio only went up from 24.1% in 2010 to 25.8% in 2019. Their net income only grew 3.64% annually as well. So what is feeding the dividend growth then? Their earnings per share. The share count of General Dynamics went from 385 million outstanding to 291 million outstanding shares. This caused an earnings per share growth of 8.2% annually, so much closer to the 10% dividend growth rate. So it is all the more interesting to see how their free cash flow developed. Unfortunately, it doesn't paint that bright of a picture. Their free cash flow went down from 2.6 billion in 2010 to almost 2 billion in 2019. On a per share basis, the effect is a bit mitigated due to the share buybacks, but it still went down from 6.8 per share in 2010 to 6.18 per share in 2019. Taking a quick look at the cash flow statement shows us that there are quite some fluctuations in the change in working capital, difference between current assets and current liabilities, and the capital expenditures fluctuate quite a bit as well. So you can definitely see some cyclicality there. The debt to equity went from a nice 0.18 to a less nice 0.78. This is due to the increase in long-term debt in 2018, which is due to the acquisition of CSRA. So as always with an acquisition that had quite an impact on the long-term debt, it is interesting to see how the long-term debt develops. In the case of GD, it seems the debt again increased to almost 13 billion in Q1 of 2020, but I couldn't really find an explanation for that. General Dynamics has an excellent S&P credit rating of A. The return on equity of GD is 27.5% and is on the higher end of their 10-year average. Compared to their competitors, only Kratos Defense and Textron are doing worse. Also Huntington Ingalls, HII, is doing better than GD with a 35.3% return on equity. Return on invested capital is 15.1%, which is on the lower end of their 10-year average. On that front, Lockheed Martin, LMT, and Honeywell, HON, are doing better, but also Huntington Ingalls is doing better with a return of about 20%. The operating margin is 11.8%, which is on the lower end of the 10-year trend, but based on operating margin, only Lockheed Martin and Honeywell are doing better. And then the value of General Dynamics. Valuation is always a bit tricky because it depends on assumptions. I will do my best to use different methods to put a value on it, but please be aware that this is based on my assumptions. According to the dividend yield theory, the yield at which GD is undervalued is 3.01%. And the price of undervaluation is $146, so with the current yield of 3.07 and the price of $143, it is undervalued. More information on how to value a stock using the dividend yield theory can be found in episode 12, which is now suggested in the top right corner. Fast Graphs is also showing General Dynamics as undervalued, with an expected annual rate of return of 22% if it would return to fair value at the end of 2021. If you liked the video so far, don't forget to smash that like button and make it turn blue. Also don't forget to subscribe if you would like to be notified when a future video comes out. Again, for all the new people that subscribed, commented and liked, thank you. Aero Financial Corporation is another regional bank. So it would be interesting to see how it stacks up to Bank First Corporation, which I analyzed in episode 22, now suggested in the top right corner. Aero is based in Glen Falls, New York. Aero provides a range of products such as online and mobile banking, wealth management, deposit accounts, mortgages, consumer and commercial loans. Naturally, Aero is part of the financial sector. With a 27-year dividend growth streak, Aero Financial Corporation is a relatively new dividend aristocrat. With an earnings payout ratio of about 45%, which has been in the 45 to 55% range for at least 4 years, it is looking good. As said before, the free cash flow payout ratio is not as meaningful for banks and it is better to look at the earnings payout ratio. The dividend growth rate of Aero is not that exciting, to be honest. With a 5.4% 10-year dividend growth rate and a 3.8% 1-year growth rate, it is beating inflation, but that is it. What is more, it seems that they have declared a stock dividend instead of a cash dividend in the last few years as a way to increase the dividend to shareholders by giving them more shares. The dividend safety score from Simply Safe Dividend stands at 84, which is a lot lower than the 99 from Bank First Corporation. I think the high risk can be somewhat explained by the fact that the market cap of Aero is much smaller than that of Bank First. The revenue of Aero grew from 0.08 billion to almost 0.12 billion for an average growth rate of 4.3%. So Aero is also growing much slower than Bank First, but their growth has been quite consistent in the last 5 years, ranging from 5 to 7%, as you can also see in the revenue graph. The free cash flow went from 0.62 per share in 2010 to 2.78 per share in 2019, but again, better to look at the earnings per share for banks. The earnings per share went from 1.54 per share to 2.5 per share in 2019. What I like about Aero Financial Corporation is their low debt to equity ratio. It went from 0.99 in 2010 to 0.18 in 2019. So that is a trend I like to see. For Aero Financials, there's no S&P credit rating. The return on equity is 13.1%, which is at the midpoint of their 10-year average, and above my threshold of 10%. It is the highest return on equity among its peers, but lower than 14.14% of Bank First. Like I mentioned before in episode 22, return on invested capital is not a meaningful metric for banks, since most of their funding comes from customer deposits. And same applies to operating margin for banks. According to the dividend yield theory, the current yield of 3.7% indicates that Aero Financial is undervalued, because it is higher than the 3.5% historical high yield. This indicates an undervalued price of about $30 compared to the current $28 price. According to Fast Graphs, Aero Financial is also undervalued and would return 21% annually if it would return to fair value at the end of 2021. Eaton Vance is another company from the financial sector. Eaton Vance is an asset manager. According to the website, Eaton Vance provides advanced investing and wealth management solutions to financial advisors, high net worth individuals, and institutional investors. Eaton Vance has been a dividend aristocrat for quite a while and has a dividend growth streak of 39 years. The earnings payout ratio of Eaton is 47.7% and has been below 50% for at least 4 years already. The free cash flow payout ratio based on year-end numbers of 2019 is around 30%. Eaton has a very steady dividend growth rate with the 1, 3, 5 and 10-year dividend growth rate all around 8.5 to 10%. This is also visible in the steady staircase pattern of yearly dividend payouts. The dividend safety score of Eaton Vance is 72 and is considered as safe. I would assume that a factor that plays into this safety score is the fact that during the last recession, the revenue of Eaton Vance declined by 22% and the stock price went down 65% during the 2007-2009 period. The revenue went from 1.1 billion in 2010 to almost 1.7 billion in 2019. The revenue went up 4.9% on average, but as you can see in the graph, the trend is not as smooth right upwards, so there's quite some volatility in revenue there. For the free cash flow, I would normally use the numbers from Morningstar, but they seem to be off for Eaton Vance. Instead, I will use the numbers from Simply Safe Dividends. The free cash flow went from $0.72 in 2010 to $4.33 in 2019. Just as with the revenue, the free cash flow has quite some swings, and during the dips, it was not even covering the dividends. The debt to equity paints an equally unfavorable picture, where the debt to equity went from 1.22 in 2010 to 1.89 in 2019. Eaton Vance does have a good S&P credit rating of A-. The return on equity of Eaton Vance was 34.9% in 2019, and about midpoint of the 10-year average. From the peers showing on Finbox, only Artisan Partners Managers, APAM, is showing a higher return on equity. However, I would also like to compare it to T. Rowe Price, which is another asset management company that I own. They show a 31.3% return on equity, so slightly lower return on equity compared to Eaton Vance. The return on invested capital was 12.24% in 2019, the lowest in 10 years. Only Federated Hermes, FHI, and again Artisan are scoring higher. T. Rowe is also scoring significantly higher with a 30.7% return. The operating margin is 30.9% in 2019, the second lowest in 10 years. Once again, only Artisan is scoring higher on Finbox, but also T. Rowe Price is scoring higher with 42.5% operating margin. According to the dividend yield theory, the current yield of 3.95% is not yet in undervalued territory because the average high yield is 4.47%, but this is skewed by the two high peaks in the dividend yield. Fast graphs on the other hand shows a clear undervaluation, and Eaton Vance would return 22% if it returned to fair value at the end of 2021. Eaton Vance is a good candidate to value using the dividend discount model, DDM. By using a required rate of return or the weighted average cost of capital from Finbox, we get a fair value of $64.8. So the current price of $38 is well below that. I've extensively elaborated on the dividend discount model in episode 13, now suggested in the top right corner. If you came this far into the video, don't forget to like the video and subscribe to my channel if you want to stay updated on future content. I've made similar videos on analyzing other dividend aristocrats, which can be found in the Dividend Aristocrats playlist, shown in the top right corner. Until next time, bye bye.